We have Okan Aybar with us, live from Turkey. Okan, great to have you. I'm very curious about where your head's at going into year end. Welcome
Hi,
back to Face.
hi, Dale. I do you hear me first? Can I ask?
Yeah,
Okay,
loud and
great,
clear. Loud and
great,
clear.
great,
Do you
great.
think there's going to be, let's start with this. You think there's going to be a peace deal?
I think there's going to be a peace deal, but it is not going to make Ukraine very happy about it
Okay,
because
so there's going to be a capitulation deal.
kind of.
Why would they take it?
Well, they have to take it because if they don't take it, I mean, Ukraine's army, strength of the army is based on U.S. So it depends on the U.S. So
Okay.
if U.S. cuts the selling of weapons, what they're gonna do? Okay,
The
so
Europeans wouldn't be enough to bridge a gap.
Europeans wouldn't want to mess with Russia at a time like this.
Okay.
Because for this reason, I think they're gonna, stay back and um, try to persuade
Yeah.
Ukraine to accept the deal.
Okay.
You know.
All right. Thanks for your opinion. Is that what you're hearing on the ground there in Turkey? Um,
Mm.
what Erdogan make any comments about it?
Actually, no.
Okay.
He didn't put any comments lately because there are other political things going on in Turkey these days. So that is not
Yeah.
on the agenda. So
Okay.
so but it's on the world's agenda, of course. So
Currency's still crashing.
which currencies?
Yours, Turkish lira.
Oh, Turkish lira. No, actually it's now strong, very strong.
Wow. Okay.
Yeah,
That's a change, huh?
well, when you compare it to the differential of the inflation levels between the US and Turkey, Turkish lira is very strong. It is supposed to be much, much weaker. Currently, it is trading at around 44, 45, against euro. Against dollar, it's trading around 41, 42. That is too strong. It's supposed to be, you know what is supposed to be something around 70, 75, something like that,
Huh.
because it
Okay.
has been kept very strong in the last 2 years on purpose. They've been, managing the float, and for this reason, they kept Turkish lira very strong. The reason why they keep it strong is because they don't want the inflation to pull up because it has political uh,
Can
consequence.
they are they putting the genie back in the bottle? Are prices starting to drop there? Because what I see on the news, it's not that way. People could barely afford to buy food.
Yeah, they're not. I mean, the food is very expensive for everybody, not only for people living in Turkey, but for tourists as well. Some any person coming out of Istanbul, out of Turkey, comes to Istanbul and they find the food is very expensive.
Okay. All right. So I was going to look at the lira, but let me give you the screen and what's on your mind market wise.
Okay, I prepared for you um, a
PowerPoint.
presentation, a PowerPoint presentation, and I'm sharing it with you.
I see it.
Yeah, you see that? Okay, great.
Yeah.
My topic today, I'm going to talk about the gold silver because I recognize lately that you have been following this very closely.
Yeah.
And so I will talk about gold silver and then I'm going to link it to DXY here. And then I'm going to link it to S&P 500, where the S&P 500 may go in the coming weeks. So let me start with the gold silver. Silver.
Okay.
Okay, on this chart that I'm sharing with you, if you realize that, at the times when gold silver increases, the gold silver's convenience yields increases. I'm following this indicator very closely. If there are people here who don't know much about convenience yield, well, that's the benefit of holding the commodity, the physical commodity, rather than buying it on a forward basis or postponing the purchase. So if you're not postponing the purchase but buying the physical commodity and stocking it, it means that you want that commodity very much.
Right.
So in this case, if this red line, which is the convenience yield, if that is increasing, as you can see, it corresponds to the increases in the gold silver ratio. So there are few examples of, I mean, there are many examples of this. The convenience yield increases, the gold silver increases. The convenience increases from level zero. That's also
Hmm.
important. That level zero means if there is a benefit of holding the gold against the silver, then it should be above zero. So anytime it goes over zero, you see the gold silver increases. So there are examples of this. Nowadays, looking at the gold silver convenience yields, you see it has been very, very flat for a long time.
Yeah.
But it has been below zero barrier, which means that there is not a benefit of holding gold against silver. There's actually cost of holding gold against silver. But this is going to change because history showed us that, I mean, this kind of long period doesn't last too much, especially after, spending 3 or 4 months time like this.
Hmm.
It is not, it cannot stay like this. And well, I look at this situation from seasonality point of view, and I'm switching to the next slide
So,
of the gold silver ratio. If you look at this the chart, you can see that the ratio is is you know towards the end of the year it goes up slightly, a little higher, it goes up. But looking at this year, I mean, this green line is showing us the 5 years average
okay.
performance of the gold silver. This blue
Hmm.
line is showing us this year's 2005 performance.
Right.
If you realize that there are only few times that gold silver has obeyed what the 5 year average is doing. So there's great divergence and convergences here. I think that going forward in the next uh, couple of weeks till the end of this year, I think that this divergence may stop and it should be converging to its mean, its average of 5 years. So this
Okay.
suggests me that the gold silver ratio may
Setting higher.
maybe trading higher. Yes, exactly.
Okay.
And
I know it's not directional. Sometimes it could be. Does that give you any bias as far as direction of metals when gold is leading silver? Um, and does this also have a correlation with the dollar? When
yes,
XAU goes up, it portends a dollar rally.
exactly. So actually, when gold silver here, right here, gold silver ratio, which is here, is shown on a blue line with the blue line, and the
Yeah.
DXY is shown with the white line. As you
Yeah.
can see,
Look
they
at that.
are very well correlated with each other, so well correlated with each other. So, but however, if you look back into the last 3 months, 4 months,
Hmm.
you realize that the gold silver ratio has been trending down while the DXY has been going up. So there is divergence here, which is not cannot be explained by this very correlation that
Is
has.
it breaking down the correlation?
Well, there is a divergence here, so the correlation isn't working here right now.
Yeah.
But I think
It'll
going
reconnect.
exactly, I think going back to this convenience yield issue, which I just explained, the convenience yield cannot stay like this for a long time. If it start trending lower, higher, the convenience yield, then the gold ratio may go up,
Yeah.
and the seasonality might support this as well. In this case, then this the blue line, which is here, might be going higher, which may suggest as us that the DXY may be supported towards the end of the year.
Okay.
So I think that in the last month, um, actually, by the way, dollar is traditionally supported on December because of the repatriation of the profits that are being transferred to the US. So there is a great demand for dollar. So on a seasonal basis, the dollar is supported anyway. So that's another reason why I
Can
think.
I ask you, this is not my wheelhouse, but I figure a guy with a Ph.D. it might be. There's all the issues we've had in the repo market and the Fed balance sheet and liquidity issues in the plumbing. Do you have a view on that?
You remember the last time we spoke about the Fed's position is that it is really accommodative. Although rates are higher, looking at the financial conditions index, which I've been talking before, um, um, sorry, I mean, US has not been as accommodative as Europe. So it has been, they have been trying to keep the interest rates higher. So when you compare it to Europe, US is not accommodative for economy. So that's why Trump administration is pushing Federal Reserve to drop the interest rates. And I think once the inflation numbers and other numbers that are linked to it start to suggest that inflation may go down, not even if it goes down, but if it is expected to go down,
And it's
then
not getting worse. Yeah.
yeah, then the Federal Reserve may start, lowering the interest rates. But
Do you have a target in the 10-year when you think this with all the easing that you see coming, we're going to trade 3.5?
that is too low. That will be
Okay.
too low.
So we're at what here now?
Uh, I,
405.
I think that most of the action we're going to see on the 2 years rather than the 10 years. So the 2 years might go down rather more than the 10 years, which may
Okay.
steepen the yield curve.
Okay.
Because if you are talking about if we are talking about wanting to strengthen the economy in the future, to accommodate for the future, we have to keep the nearby interest rates down rather than the 10 years interest rates.
Well, let me ask you this. After an inversion, which I forgot when we uninverted, I don't think we're still inverted. So now, after you have an inversion, this was a pretty deep one. And, it's not a trigger, but I saw something that there's been big lags in the past between yield curve inversions and it finally having an impact on markets. And I think it's been a few years since
I,
the
I
inversion.
actually I actually have a chart on this, if I may show you.
Oh yeah, you're
Sure.
you're also a mind reader.
Yes.
My goodness, you're a multi-dimensional guy.
Here it is, Dale.
Yeah,
You see this yellow
yeah,
line? Yes.
yeah.
This yellow line is the time when the yield curve was inverted back in 2022.
Okay,
The
3 years
highest,
already.
yeah, exactly. The highest was on June or August in 2023. That was the highest point.
Yeah.
And then from then we started heading down. Now we are not inverted, we are barely normal. Why? Because
Okay.
we're too flat these days. That's the
Okay.
reason why the Federal Reserve is going to want the not the 10 years, but the 2 years. So they are going to want to
Right.
influence the nearby
Right.
terms lower.
Okay. Well, that's all they can anyway, unless they get into like what's that, yield curve controls? Is this yield curve control what they're going to do?
Well, this is not controlled. They cannot control the 10 years.
Okay.
That would be too risky. I mean,
Yeah.
why? Because controlling the 10 years means that, they bring a lot of volatility for the hedge funds, which the Fed doesn't want to
Okay.
do. So that's very, very risky to do. They don't want to do yield curve control. They would simply go with the traditional way, and they will definitely, sooner or later, perhaps after any kind of um, if the China and US war, I mean, what I mean by war is a
Trade war.
trade war, yeah. And if that ends, which I think may end, because that is to advantage of everybody. And if the Ukraine war ends too, then you might expect the Federal Reserve to keep the interest rates lower very quickly, very, very quickly. They're not going to wait.
Okay.
Um,
All right. Interesting. So what's your view on S&Ps then?
yeah, so going back now, I want to talk about S&P index.
Hmm.
Looking at, okay, since you mentioned about the risks of US, I have a indicator here, which is this red line, if you can see. That is the differential of the 10 years, zero coupon inflation swap rates. That is supposed to be not F. Zero coupon inflation swap rate, ZCIS. Why did I write F? Okay, ZCIS, right? The 10 years minus the 20 years, okay? If this um, if this line keeps rising higher, like it has been rising in the few couple of months, it has been rising. It means that the risk premium, US risk premium is increasing. What I mean by risk premium is the risks that are that are not the inflation risk, but other risks, such as the country risk, political risk, price risk,
Credit risk, private
credit
credit.
worthiness risk, exactly. So all kinds
Yeah.
of risk I'm
Okay.
talking about. The risks that are not associated with the inflation, but of course they are associated with inflation indirectly. But these risks are just called as a risk premia. We call it risk premia or risk premium.
Yeah.
So ZCIS differential is a very, very good indicator. And the best thing about it is it's a market-based indicator. So you can make that for yourself just by taking the differential of these rates. And they are available, I believe, on the Federal Reserve database. You can
Look,
find.
you just had a little blip, and look what happened in April. That was the tariff decline. And then it pulled back with the rally to new all-time highs, and now it's turning up again. Am I
Exactly.
saying that correctly?
Yes, exactly. Exactly. That's
Okay,
right.
interesting.
And also, if you realize that lately this persistence, why I call it persistence, because if it is going higher, it means that the expectation that the risk factors for the 10 years is increasing. So if the longer period is increasing, then it means that the persistence is increasing
I
because
see.
the 10 years are increasing against the 2 years higher, much more than that. So for this reason, this red line recently has been going up. However, S&P has been going up too, which is not, it is not supposed to go higher because you see, because they move against each other. As the S&P moves higher, this red line moves lower. You see here, it moves lower,
Yeah.
and this goes up. And then from, as you mentioned, from April, when the tariff war began, this red line has started increasing and the market declined. But since then, the market didn't stop. The market only rose, 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 while the risk premium was rising. This is not normal. So
Yeah.
I think that going forward, because this dollar index is, I expect it to increase, then it is a threat against S&P's rising any further. Because from this point on, I don't think that S&P can continue to rise while the dollar is rising. So if the dollar is going to rise going into January 2026, then I mean, what is the scenario that can pull S&P even higher than 7,000 points? I don't
Well,
see
could
it.
the dollar pull back to 98 first before it blows off to 103?
Might happen, that might happen, but if it is going to happen, it has to be very quickly. I mean,
Right.
nowadays we are at what, we're at 100.
Yeah.
Yeah, about 100. So maybe 90, maybe 98 handle, late 98 handle or early 99 handle.
Yeah.
And then, well, that I mean, it is supposed to come to that level in the next one or two, and then it can continue higher.
You
Jan
have
into the
upside targets for the Dixie in this period you're describing?
103, 104 max
Okay. Yeah.
maximum.
Okay. So it's still a bear market rally.
Yeah, exactly. Yeah.
Okay. Got it. All right.
So
Great. Good
given
stuff.
so because thank you, because this is dollar strength we're talking about these days.
Yeah.
And I see no reason why a sell-off in the S&P 500 may come.
Yeah. Even your arrow, when you look at that chart, a break to 6K looks like a blip.
Yes, yeah, yeah, it might
And
happen.
that's so a correction in this dollar rally is a correction, and this pullback in the S&Ps, even though it could be 10-15% is a correction.
Exactly. Yeah, because from a risk-adjusted point of view,
Yeah.
S&P is way, way, way too high from risk-adjusted point of view. I mean,
Yeah. Wait till next
well,
year.
sorry?
Next year, if we have a melt up, it'll get even more extreme.
Yeah,
Because if
yeah,
this is just a pullback to 6,000 and we're blown off to new highs, I guess a lot of these numbers will even get more extreme.
yeah, yeah, exactly.
All right,
But
buddy. Well, we're kind of near go ahead, show this last one here.
oh,
Go
sure.
ahead. Go-
Very quickly, very quickly. I'm going to talk about the crude oil.
Okay.
I am looking at this 2 year to 10 year, well, the yield curve. Yeah.
Yeah.
Okay, I am comparing the yield curve with the convenience yield
Mm,
of the crude oil. You see, when the convenience yield was here
yeah.
at its lowest,
Yeah.
the spread was, I mean, the yield curve was inverted, which means that the economy was strong back then, but expected to weaken. Now, today, um, this convenience yield is exactly the same level, but today the yield curve is just the opposite. The yield curve today is telling us that economy today is weakening. However, it is expected to strengthen. So in looking at this scenario and compare with what the crude oil has been doing, you see, in this scenario, crude oil has been trending down. In the next scenario, that is current scenario, I think that the crude oil may start to go higher, at least about 6 to 7%, because uh, because I mean this $58 is not,
So back
is,
to about 64 is a
yeah,
technical level.
yes, exactly. About 64, 65, that is very possible. I'm not going to be
Come on,
surprised.
bet the farm, man. Put on
See?
1,000 futures contracts right now. And put your stop under the low of the day.
I will put 1,000 contracts if I had $10 million, maybe.
All right. Well, great to talk to you towards year end, Okan. Best place for people to follow your very interesting, indicator. I haven't heard anyone talk about the convenience factor of holding physical commodities. So you definitely are a market thinker. So how would people go about keeping in touch with you and your work?
They can contact me over X and also LinkedIn. I'll be more than happy to answer their questions if they
Okay.
have. I will be more than happy to help anyone who wants to contact me.
Okay. And Okan's handle on X is his name, Okan Aybar. And it's definitely worth the time to see what he's seen under the hood of the market, because I've seen some pretty good forecasts out of Okan. And I want to thank you for, coming here. How long have we been doing this now, buddy?
This presentation
Yeah,
issue,
talking to each
for
other.
4 years, no, 3 years.
Okay. All right.
Yeah.
Well, I want to thank you for coming here every quarter and edifying the face community.
I thank you, Dale. Thank you very much for giving me this opportunity.
All right. Well, trade well. I hope you have a great close to 2025, and we'll catch up next year.
Sure, sure. More than happy.
Okan, all right, Okan Aybar, everybody. You learned something new about when people take delivery on physical commodities and what the implications are, and some pretty good things to think about with the gold silver ratio, the dollar, and the 2 and 10. So again, thanks again, Okan, and everyone. Don't just count your oil barrels or your treasury spreads. Count your blessings, and we'll see everyone tomorrow. Adios, and thanks again, Okan.
Thank you, Dale.
All right.
Have a great year end.
Thank you, man. And there people are thanking you. All right, everyone. Adios till tomorrow. See you then. Oh, join the team in 14 minutes on the morning edge and sharpen yours. See you later.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.